Happy Labor Day once again, part two of the Dow, the pro and con of bear and bull market rallies. And back we were talking about year-end bonuses and big rallies that need to happen. We are not going to rally back up and take out that bull. The bull rally is that they're going to depend on the government and another big round of stimuluses. And what has not happened over the last year and a half is that there's changes in policy and that you got more of an equal balance that people will work with when making policy for the American public. And you hope that you get to an equilibrium and an equal balance where people aren't pointing the finger, well, that was your fault, this didn't work, that didn't work. No, we need to get out of the pointing the finger, and we need to get down to the core aspects of what needs to be done and what can be paid back. And instead of trying to put all of this problem, one of the things that would make a rally is that instead of buying up all of the illiquid assets at the taxpayer and the government expense, is that one of the key factors in America is a housing market. That's the house you live in, and that's your dwelling. Everyone should have a place to live, whether you own or rent. But if you're an owner and you're in a house that's $600,000 and it's currently worth $300,000, and you're paying $5,000 or $4,000 a month, but you can go get the same house for $1,500 a month and you can get rid of the debt, that's where the foreclosure market's done its thing. In order to stop that, what has to happen is that the asset value needs to be written down to the private sector, which is the consumer's payroll. And basically, even if you don't do the tax, if you extend the tax hikes and you give a tax holiday and you give incentives and everything, remember the core asset is that monthly income relative to what the individual consumer's debt to ratio is. So that our manufacturing in the U.S., they need to do a lot of things to get that thing turned around. I think manufacturing jobs are at their all-time lowest levels over the last 3 or 4 decades. I don't have the exact numbers, but I'll get them for our traders. The thing about it is that they got to write down the asset to meet that. And that means that there's a big gap between what that value was and what that value is today, what the payment is today, and what the payment should be. And that ratio of debt in the U.S. need to be written down directly to the consumer and directly to the smaller business atmosphere. And the thing about it is, these things should have been the things that should have been addressed in the correct and the right way. They weren't. They were done totally backwards. You were trying to buy your way out of a problem instead of get to a point of writing down the asset where you could start to grow at a lower rate for an extended period of time and re-leverage the consumer's debt to ratio and getting the correct debt to ratio in the housing market. And that means the write downs directly to the consumer. So that would stop the foreclosure rate, it would stop the doom and gloom effect, and it would get to a point where the asset value of the classes of the asset value are in line with the economy. And there are certain curbs, there are certain things that could be done. Now, when it comes to stock market and stock market behavior, is that if they come out and they give the glorified package of doing everything to get the people from being pessimistic back to doing the right thing, the euphoric part is that all of the taxes, we're not raising taxes, that's going to be that part of it. But remember, you're still going to grow at a lower growth rate, even if that happens, because it takes time to get into the system. So if they come back on a second round of stimuluses, but if they're healthy stimuluses that promote business with the right kind of rebate structure, I didn't say social structure, I said the kind of right tax relief rebate structures to grow business is the key. There's lots of things that have to be done. So if they come out and say that you're going to get a big pop in the market to the upside, tomorrow's going to be the opening day. And September and October can be bad. And we've called the market tops and the market bottoms. So you've got this big wound up machine right now waiting and wanting and re-electing for that hope. That's what America's looking for. When is this going to end? Well, guess what? You can still make a lot of money in the stock market, whether it wants to go up on that hope or if it goes down on the failure of that hope. It really doesn't matter. SMF Street's diversified in both bull and bear markets. The important thing for SMF Street traders, new people in the school that are actively trading, is that we set those risks accordingly to both the upside and the downside. So what I'm telling you is, on the chart here, on 4-1, when we called the market top over as we were going up in there, we have those live videos on the site. You're not going to break these all-time highs up here without that wild card coming into play. That means that policy, administration, and elections all have to play out in favor to get that exuberance of that move. Just remember, SMF Street, even if we pop and they do the wild card move, are they humble enough is yet to be determined. They're already kind of talking a little bit about this and a little bit about that, a little bit too much pointing the finger at other past presidents and other failed policies. Hey, that's then. Here is now. And the amount of pent-up demand for hope, people do want to feel better, and they should. The thing about it is it going to be healthy or not? So far, it hasn't been the way that it should be. We can do it correctly. We can grow at a lower growth rate for a period of time, but when we do start getting a higher growth rate, at least it'll be able to be paid back and pay down the deficit over years to come, forward looking, and things could really turn out well. So basically what I am going to say is if they come out, we could see a nice big fat rally. 14,000 was the top of the Dow. Now, if there was enough hope over time going out into 2011 in year-end trade, you could get back to 12,000 on that Dow if things were done right. The problem is if they're not, so we could break to all-time highs. It is possible. It's a wild card. We're ready for that trade. But we're also ready for the failure of the trade, meaning that if nothing changes, guess what? Nothing changes and more weakness gets into the economy than you currently understand it. So we have to be able to have I guess the right word would be a survival rate at 1.5% GDP. And that the jobs that we put on, yeah, they start out temporarily, but then they grow into full time. And you can't go from a temporary job to a full-time job unless there is productivity and or sales are going higher and things are working in the right way. If we tax America right now, we're going to have a huge problem. That's where you could come down here, on the other hand, and break 6,000 on the Dow very easily, and down you go. So there are two sides to the story. And there is a way, it's not going to happen overnight, but if we don't get the right people doing the right thing and the capital structure to grow business, you're going to go down. And any up move will fail. There are the bull and bear rally that will start tomorrow on 9/7 that ends on the 31st. We have a system, a platform that will tell us. The thing about it is there's a lot of money on the sideline, and part of being an American is that we all hope that people will eventually get into Wall Street, make some healthy investment, did their homework, learned what they were doing, and grew their balance sheet. Because that's what markets are for. And they should be a fair playing field for everyone, which they're not. Here, SMF Street has opened the door to Main Street so they can get a fair playing field. And the thing about it is, the wild card is they totally do the opposite of what they said. They're not going to raise taxes. They're going to do the right thing. They're going to give payroll incentives. They're going to keep the payrolls up. Hourly earnings are going to go higher. Yield curve is going to be working in the right way. Asset classes are going to hold value and grow. You can't go higher to 12,000 on the Dow up here unless it happens. The other side is it would be a great bull rally for the end of the year, and that would be the wild card that we're going to do something. But so far, the American public has been let down every time. And it's not panned out to be what it was. Yes, they've done some things that needed to be done that they had to do. I'm not saying that everything they did was 100% bad. But I am saying is that irrational exuberance and high deficits and taxing your economy moving forward and not getting a small business community going, and the healthcare bill that was passed, hey, that's still a big overhang and big issues. We got a lot of issues to overtake. But if we start to work in a responsible way, we can go a lot higher in the Dow. If we don't, we're going to go a lot lower. Because if they don't do the right thing and things aren't done, we're going to go all the way back down to where the 2009 rally started. That's over here. That's your expansion. But that expansion isn't going higher, and we're going to be finishing out the year. So if the right things happen, we can take out that reversal high right here on the upside. However, one needs to be careful outside of that is knowing where the stock valuation is. Has it already priced in this turnaround or not? And that's going to be the key. We'll talk about that next in the next tape.